What is up, everybody? It is Friday. It is the 10th of April, day 15 of my COVID campaign for financial awareness. It is also Good Friday, so happy Good Friday to you all. It is a long weekend, even though this feels like the longest weekend there ever has been in the history of the world. So enjoy your long weekend. Obviously, be safe. Don't go to family gatherings. Don't have family gatherings. Have a virtual meeting, do whatever you got to do to get your family fix in. Enjoy yourself and the people in your household. It is Easter weekend, so I want you all to have fun, but I want you to do it in a safe and careful manner so we can keep rolling with the progress we're making in terms of the coronavirus. So, today, what I want to talk about is timing the market, and timing the market's an interesting one. And the reason why I'm going to talk about timing the market is because my usual market update that I give every day, we are not going to give today. Reason being is the markets are closed because it's a holiday. So what I'm going to do is recap what happened this week on the markets, and then show you a post of mine about timing the market and why it's something you do not want to do, and it's a bad investment strategy. So one of the things that has been happening a lot recently is people have been interested in timing the market, mainly because we saw such a steep decline very quickly last month, in the month of March. So what I want people to understand is why this is a faulty strategy, why you can profit from it, but you have to actually come in the market at a good time and then make sure you leave at a good time. But that is difficult to do, and most people cannot do it. People who try to do it often get burnt. First things first, though, let's take a look at the markets this past week. So yesterday, what we had was a 1 to 2% increase in all North American markets. That includes the NASDAQ, S&P, Dow Jones, and TSX here in Canada, Toronto. So overall, this week was a good week for all markets. Toronto actually gained about 9% this week, which is pretty awesome. But one thing I will caveat with that is that 9% was actually 9% of its current value, which is lower than its peak. So 9% isn't a 9% gain towards the good because we are at a lower market. Overall, though, still pretty good week. These past 5 days, we started off the week at about 13,000 and ended over 14,000 for the Dow Jones, or for the TSX in Toronto. That's pretty good. I will take that. It's optimism, and I think part of that, of course, is the fact that we are starting to curve this corona trend. The number of cases have declined on several days in a row, so the case number is going down. The case number is still pretty large, but it will go down if we continue doing what we're doing and we keep testing and we keep figuring that out. In terms of New York City, we're looking at the Dow Jones Industrial Average. This past week, we had a 10% increase. That is pretty good as well. So that 10% equates to about 7% in the good of getting back to where we were. Obviously, the market was down about 30%. So if it's at its 70% capacity and you gain 10%, that means you only really gain 7%. So 10%, though, that's a solid week. We are almost back to midway of what we have lost. Overall, the market saw about a 35% decrease, and now they're down about 20%. That doesn't mean that they're going to go all the way back up real quick. What it does mean, though, is that they are on the track to go back up. They could go back down if negative news comes out. This is the NASDAQ, 8.9% over the course of the week, and the broader market is the S&P 500. That encompasses the majority of companies that we invest in, and that was a 10% increase. So we are on track to get about halfway back of our losses that we've experienced. We are 20% from the heights that we reached, and that was about February, mid-February. So we reached market heights. New records were made. So we also made new records with losses in a shorter period of time. So we are 20% down still overall, but we can get back there if we continue actually doing what we need to do to make sure that we stem this coronavirus curve. The government has injected stimulus. We are actually on track to hopefully see less cases overall as time goes on, and less cases means less deaths. So that's a good thing for everyone involved. So let's get to my post, So You Think You Can Time the Market. This is a post I released in late 2017. Timing the market's a tricky game. A lot of people try to do it. Now, I have told people it's a great time to invest, and the reason I say that is because markets are low. But one thing I've said as a caveat is that if you're going to invest now, you need to be investing for the long term. And this is money that you have sitting on the sidelines. This is money that's not going to affect your budget and you may need over the next little while because we are actually going through a tough economic time right now for everyone. No matter who you are. So I want people to make sure that their budget is safe. And that's why I keep giving the resources. I want people to lay the foundation. But in terms of investing, if you do have cash on the sidelines, that's not going to affect your day to day. It is a great time to put in the market. One thing I would stress to you, though, is do not expect to double up your money in a day or make a certain percentage in a day. You need to be able to put your money in the market and leave it there for an extended period of time. The reason being is because we don't know when the market's actually going to get back to its heights. It could be a month, could be 6 months, could be a year, could be a couple years. And I'll explain that in a second. So one reason, I give 5 reasons why trying to time the market's very difficult and very bad is buying low and selling high. So we all know buying low, sell high, buy low, sell high. The reverse is actually true. Most people buy high and they sell low. When markets were hitting their heights in late January, early to mid-February, people were buying into the market with huge optimism, and they missed the train. If you bought in at that point, you are actually down quite a bit right now. And the reason being is because you bought at its peak. The problem with it is it doesn't mean you actually did something wrong. If you're buying into the market to invest for the long term, there is no bad time to get in. There's better times to get in, but there's no bad time to get in. You're getting in because you're getting in because of a reason, to invest for the long term. And what happens in the short term does not matter if you're investing for the long term. So just because you got in at the heights doesn't mean that you made a bad move. Just because you get in at the bottom doesn't mean that you necessarily made a smart move, because it could go lower. So we never know where the bottom is. We never know where the top is. We only know later. We know a year from now where the bottom was, or where the top was. And you can't predict that on a day-to-day, week-to-week basis. So I give the example of Enron. In 2000, the year 2000, and many of you have heard of Enron, but this is an energy company. It was a natural gas company that was one of the biggest in the world. In the year 2000, it was trading at $90 a share. A lot of people who worked at Enron had their pensions or their retirement funds within Enron. So at $90 a share, people thought that the stock could go nowhere but up. A lot of people were buying in at $90 a share. Little did they know that a year later it was trading at $20 a share. So they lost over 75% of its value. So that's a huge, huge, huge drop. People actually doubled down at that point, trying to double up and actually put their money back into Enron at $20 a share, hoping it would go back to $90 a share. So they've lost money at their $90 a share when it went down to $20. So they buy more in, hoping it'll go back to even and actually generate a profit. 4 months after that, though, the company actually went bankrupt and everyone lost everything. There were people who didn't lose everything, and those people were actually involved with insider trading. So the only people that can really predict the market are people that are actually doing it illegally. So the regular person like you and I, we can't predict the market. We don't know when it'll go higher or go lower. What we do know is that Enron was a good company at the time and later on became a bad company because it was fundamentally flawed within it. So what we need to do is actually invest in the broader market and make sure that we're diversifying our portfolio, and we can't get baited into one stock such as Enron or any other company that could go under at any given moment. And that's why I believe in mutual funds. So this is just one example of showing how timing the market could be a bad, bad thing. Now, obviously, Enron's the extreme of it, but it doesn't take a drastic drop like that to make you lose money or actually make you get out at the wrong time or get in at the wrong time. Second reason I give is you're going to miss out on drastic rebounds. So for instance, if you're trying to time the market, every time there's a downturn, there's a subsequent uptick. Now, if you get out of the market when you think it's at its bottom, the problem is with it is that you could get out when you think it's at its bottom, and it could generally go right back up and you miss out on it. Now, if you look at over the past 2 weeks, we've seen a 15% increase in the market. Those who got out at its bottom have lost out on that 15% increase. I've seen a lot of portfolios of my clients drastically climb back to almost where they were before this happened. I saw people buy in when the markets were really low, and they're springboarding even quicker. Now, the biggest thing about it is that we don't know where that bottom is. And if you switch your investments to fixed income or cash, you can miss out on a 1-day gain or a 1-week gain that will actually make you springboard almost back to where you were. And no one knows when that is. So that's the huge problem. I give 3 examples of how this happened. The Korean War in 1950, the market lost 15% in 5 weeks. 15%, 1-5. After 6 months, it was up 31%. It took 3 months for it to get back to its original level. 6 months later, it was up 31%. That's a huge, huge difference. Now, if you get out at the wrong time or get in at the wrong time, you're missing out on all of that. So the key point of this is that if you're getting in for the long haul. If you're getting out, it's because you actually want to liquidate. That's why. September 11th, 12% in 1 week after the September 11th attacks on the World Trade Center and the Pentagon. 12% in 1 week. Within 6 months, it was up 19%, and it only took 2 months for it to get back to its regular level. And here's the big one, the U.S. financial crisis in 2008. So we looked at 36% drop in 10 weeks, and this is through the fall of 2008. Change after 6 months, it was positive 11%. 2019 actually was a big year for the stock market. Time to return to its normal value or value at its peak, 27 months. So that's just over 2 years. So if I told you that you put money in the market at its bottom and you would make 30% or 36% in 2 years, would you not do that? Of course you would. You'd be a fool not to. So if you have money in the market and it's low because the markets have gone down huge, would you wait 2 years to recover it back? Now, that's the longest recovery it's ever taken. So that's the thing. You got to look at it. It's like, okay, if the market takes a year or 2 years to recover, are you willing to wait for that? Basically, you should be, because if not, then you're not a long-term investor. You're just playing the stock market. Dollar cost averaging is a huge one. I talk about dollar cost averaging all the time. Now, if you're putting regular contributions into your account, so you put $100 every 2 weeks when you get paid. If you are actually doing that on a regular basis, even when the markets are low, you are winning. That's a really, really cool thing. So for instance, I give the example. If you buy 1 share or 1 unit of a mutual fund every week or every month, and it costs you $10 for that 1 unit, after 4 months, logically, you're going to have 4 units valued at $40. $10, 1 unit, 4 months, 4 units. Makes sense, right? In that 5th month, though, the market actually goes down 50%, and you still make your contribution. So your 4 units is now worth $20. You have technically lost $20, but you haven't left the market. You stay in the market. And you still buy your $10 worth of shares that month. This month, though, your $10 gets you 2 shares. So after that time, what you've done is you have 5 shares valued at $30. The next month, the market rebounds. At that point, what you have is actually 6 shares valued at $30. My apologies. You had 4 valued at $40. You bought 1 more, or $10 worth of more units, so that got you 2 units instead of 1. So that means you have 6 shares valued at $30. The market has dropped 50%, so you have lost 50% of the value. But in that 5th month, you bought 2 shares instead of only 1. In the 6th month, you actually buy the market goes back up to where it was, so it goes back up to its flush level where it was. And instead of having 5 shares valued at $50, you have 6 shares valued at $60. So you've technically made $10 during that time. So that's just a small example, and that's why people, when they buy when the markets are low and they have a long-term outlook, they can win. If you're buying on a regular basis, what's going on with the market on a regular basis shouldn't really concern you that much. So that's a huge thing. Dollar cost averaging, I talk about it all the time. It's something that can actually help you springboard your investments, even during low periods like right now. Investing is like a bar of soap. The more you touch it, the smaller it gets. Every time you touch your investments, they shrink. Oftentimes, there's fees associated with that, withdrawal fees that will make them shrink. Your investments only work if you have a long-term fundamental outlook where you're looking towards investing for a long period of time. Buying and holding them is the best way to make money in the long run. This means you should have the fundamentals down, and that's why I talk about all the time. Have the budget down, have the insurance down, have a solid job, have income coming in on a regular basis. That's why it's so important, because your investments should be there not to be touched. The only thing that should be going on with your investments is money going in, not coming out. And that's a huge, huge thing. Time consuming. Trying to time the market. I mean, I watch the markets every day because that's my job. It can be very stressful, and I want your money every day go up and down and it can be very stressful. And if you're worried about what can happen at any given moment, it's going to stress you out if you make the wrong move. And you don't want to make the wrong move at the wrong time and then have it come back and bite you in the butt, mainly because your emotional status after that will be very bad. You're not going to feel good about it. It's way too stressful. It takes up too much of your time. You're better off just setting it and forgetting it and leaving it alone. And those are my 5 reasons why trying to time the market's a huge, huge mistake. I'm also attaching this post from Investopedia on why market timing fails as a moneymaker. And this is them saying it, not me. So I want you to understand that this is a failed way to make money in your investments. And people who try and do it overall, you might be right once, but overall they get burnt in the long run if you continually try and do this. I'm also going to attach today my how to retire relevantly, step 5, investing. This is my post about investing as it pertains to your retirement income and getting ready to make sure that you're ready to retire when you want, not instead of if you can comfortably, period. You don't want that. You want to be able to retire when you want, early if need be. And that is part of my 7-step relevant retirement system. That is part of it. So I want you to check that out as well. So if you can, take some time today, Friday, and tomorrow if you qualify for the Canadian Emergency Response Benefit. Check out the website today and tomorrow and Sunday, Friday, Saturday, Sunday. Anyone born in any month can apply, so it's a free-for-all day. If you have not applied, apply now. I warn you that wait times on this could be a while on the internet. There's also a phone number that I'll attach in that, so that's a good way to get a hold of it. So apply, get the benefits that you need. It takes some time to get in, so make sure that you apply as well. If you want to see all the catalog of videos that I've had, there's going to be the 15th one today. So there's 15 videos, 3 full weeks. So we're halfway through my 6-week campaign. They're on YouTube. So that's Joseph Francis on YouTube. That is Budget Boss on YouTube. So I want you to check that out, and I'll complete the link in that as well. Best way to check me out is on Facebook because it's more dynamic. I can put more links, more information, more tools and tips for you on Facebook. But I'm also on Instagram as well. My Facebook link is tagged in my bio there. And I'm also on Twitter as well as LinkedIn and everywhere else you want to be. So check that out. You can also reach me on my website. You can go to www.budgetboss.ca and click contact. And that is the best way to get a hold of me. You can go through there and actually add your name to the email list or even book an appointment to talk to me or actually have me help you with your finances, which hundreds of clients have done so far. I'm very happy and proud about that as well. Also, download the combo expenses worksheet. Very, very useful tool. I'm going to be releasing more worksheets as the month goes on and to help people out with their finances, including debt calculator, net worth, things like that to really help people. Once I use with my clients, I'm now going to let the cat out of the bag and share with everyone else. So I want people to check out that, download the worksheet. Hundreds of people have done it so far, and I'm really happy and proud about that. So it's Friday. It's the 10th. It is Easter weekend, so enjoy your Easter. Have an Easter egg hunt around the house with the kids. Make sure that you're continuing on with the social distancing and the physical distancing. Don't leave the house unless you have to. Go for a drive on your own. Go for a walk on your own. Make sure you're keeping those distances away from people. We want to stem this curve and make sure that we get out of this, get our summer back. And it looks like it's working, so let's continue doing that. And I want everyone to be safe and healthy this Easter. So have yourself a great weekend, guys. I'm going to see you on Monday. Peace.